All right. Today is Wednesday, January 5th, and this is a recap for the stock market activities today. Folks, I got a good one for you tonight, and let's dive right into it. In focus. Santa delivers the bags.
Ho, ho, ho! Merry Christmas!
It appears that Santa has been naughty this year. He thought it was Halloween. He tricked you. He created the so-called Santa rally, which we now know is nothing but a sucker's rally because the retail crowd poured billions and billions of dollars to buy the dip. And all of that is poof, gone in Santa's pocket. But I know what you're going to say. You're going to say, you know what? This is the American Santa. And he's naughty. He lied to us. But guess what? This Friday, we got the Russian Santa. And he's going to help us out. Buy the dip. I got bad news for you. The Russian Santa, he's only going to pump natural gas prices higher because he works for Putin. But the point being is, when the bulls are so disparate, the Santa rally, the end of the year rally, the beginning of the year rally, the Jupiter rally, the God rally, it's probably a good idea to get out of the market because we are at the top. And the problem all along has been Papa Jerome Powell, aka the Hawk, aka the Grinch. Although he came a little later this year, or shall we say, the year after that one. But he's been there all along. He told you, he gave you advance warning that he's going to end the party. And you said, you know what? I don't believe any of that. Papa Jerome is on our side. He's just bluffing to create bear traps. Okay, but here's the problem. Today, the yield on the 10-year reached 1.7%. So give us the Muppet with the fire thing. You know what? It's 1.7. Give us the two Muppets with the fire thing. Dos Mupitos. Matter of fact, give us all the puppets with the fire thing. Here we go. You see, when the market is so overvalued and hooked up on coke, the moment interest rates rise slightly higher, because 1.7 is nothing in the grand scheme of things, it will rattle the market. And this is exactly what we said over and over again. But you know what I want to talk about today? It's not any of that. It's Panda Express, because today I was sitting on the couch and I was looking for the remote. And just like your ass crack, where your underwear gets stuck there, the couch also has an ass crack between the cushion, and the remote always gets stuck in there. But this time around, as I'm looking for the remote, I found an old fortune cookie from Panda Express. And I opened the fortune cookie, and this is what it reads. A simple lifestyle will guarantee a happy existence. Okay, even Panda Express is gaslighting us these days. Because this is like saying an ugly spouse will guarantee a happy marriage. I mean, think about it. He's never going to cheat on you because nobody wants to bang him. You see how smart we are? I mean, think about it, ladies. You get yourself an ugly man, he's never going to cheat on you. I mean, we might be ugly, but we got a big heart. Now, when we talk about the stock market and interest rates and the 10-year yield, think about value stocks as your ugly spouse. You might have up and downs, but they're never going to cheat on you so long as the 10-year yield is rising higher. Unlike the attractive names like Nvidia, Tesla, RKK, they run really high, you get excited, and then they do you the ugly, and they stab you right in the heart. When we look at the performance for value stocks, this is the best start of a year in decades versus growth counterparts. The last time we've seen such outperformance by value stocks versus growth stocks was back in 1995, and back then we had a little inflation scare. Now that was a transitory inflation, was the tequila crisis, the Mexican pesos, and interest rates surged higher, and therefore value outperformed growth in the beginning of that year. And so far, we're seeing the same happening right now. The difference between today and 1995 is the fact that this inflation is entrenched in the economy. It's all over the place. It is not transitory. The Fed is becoming more hawkish by the day. Look at this chart, for example. This is Wells Fargo's growth at any price in white versus Wells Fargo reopening plays in green, or whatever that is, aqua. And these are proxies for value stocks. They're beaten down, reopening kind of names. And in yellow, you have the 10-year yield. And notice that every time the 10-year yield spikes higher, the so-called growth at any price aka Tesla Witch, Cathy Wood, RKK. These kind of names take a dive. And when the 10-year yield starts to cool off, we see these kind of names moving higher. And this is the playbook, folks. You gotta watch the bond market, specifically the 10-year yield, and you're gonna nail the market every step in the way. But I know what you're gonna say. You're gonna say, these are all old man stocks, bro. These are value traps. You're gonna regret it. Stick with growth. Stick with FANG and the big caps. Technology is the future, bro. Technology is the present, right? It's already the future. It's already here. A matter of fact, the big caps, right? The largest US stocks, almost as expensive as during the dot-com bubble. And this is the median PE ratio of the top members in the S&P 500. And look at that. It is rolling over. Now you might say, how do you know that this is the top? It could move higher again. Yes, you're right. But the risk versus reward says you're getting closer to the dot-com bubble mania. It is probably a good sign to change strategies. And even Wells Fargo says, be careful, the S&P 500 will drop 10%. I say make that, how about 35%? But rest assured, you don't have to listen to me or Wells Fargo. What's up with the FUD, bro, right? Listen to the criminals at JP Morgan. JP Morgan strategists say global stock market party far from over. Yes, you're walking like a mummy with your blindfold on, but we at JP Morgan were guiding you. Don't worry, that's not a cliff right there. That's just the Grand Canyon. It's beautiful down there. The folks over at Barron's ask, asset prices are climbing as debt soars. Will we be ready when the music stops? And I say, hell no, because the party will never stop. The music will never stop. If the Fed raises interest rates, it's going to crash the stock market. It's going to crash the economy. Papa Jerome is never going to do that. And here's Papa Jerome for you. The headline reads, why wait? The Federal Reserve should raise interest rates right now. I've been saying this. Larry Summers have been saying this. El Arian has been saying this. Top economists have been warning that the Fed is behind the game, and Jerome Powell realizes that now, and therefore he's acting hawkish. And yesterday, even the dove of all doves, the demon from Minneapolis, Neil Kashkari, he became hawkish too. And the bulls today were saying, you know what, buy the dip, buy the dip, buy the dip. It's an opportunity to buy, because when the Fed comes out with the minutes, the FOMC minutes, all the shorties are going to cover because Papa Jerome will be dovish. Papa Jerome came out, and he was more hawkish than I even thought. Federal Reserve officials signaled greater discomfort with high inflation at their meeting last month, where they eyed a faster timetable for raising interest rates this year. Let me ask you a question. Are you really that stupid? We have an election in 2022. Hello? You want to go and head to elections with this high inflation? This is a guaranteed recipe to lose. So what are you saying, bro? Are you saying we should head into the elections with a stock market crash? Yeah, it's a bad choice either way. But Biden can go out and say, you know what? We don't care about the stock market. The stock market is for the rich. Come on, man. We care about the economy. Inflation is down. Oh, but you're a conspiracy theorist, bro. The Fed will never coordinate with the White House. That could never happen. Okay, here's Lisa Abramowitz, who says FOMC comments on the balance sheet. Market participants began to discuss how balance sheet policy might feature in the committee's plan for reducing accommodation when warranted. Although expectations for the timing of the first decline in the balance sheet were diffuse, quote-unquote, while almost all FOMC members agreed the balance sheet reduction could happen after the first rate hike, they judged that the appropriate timing of balance sheet runoff would likely be closer to that of policy rate liftoff than in the committee's previous experience, quote-unquote. Fed members seem more willing to shrink the balance sheet sooner after liftoff, and potentially more quickly, since the current maturity of the Fed's holdings is shorter than in prior years and would shrink more quickly if the central bank stopped reinvesting repayments. Now, what does that mean? The Fed is not just tapering, it's not just raising interest rates, it is also shrinking the balance sheet. Folks, the criticism is immense here. The Fed committed the crime of the century, creating the biggest wealth gap in the history of this country, and an inflation crisis that pretty much killed and destroyed the American dream of owning a home and only benefited the rich. And now that the rich already dumped, they feel less pressure to rewind that policy and start tightening again, from quantitative easing to quantitative tightening, which will leave the stock market in shambles. And guess who's going to end up holding the bag? The retail crowd who are chasing the lottery ticket. Well, guess what? The winning lottery ticket has been already drawn, and it reads, the rich. They already won. They already cashed in and said goodbye. I mean, you think Papa Jerome works for you? He's so worried about your call options and your portfolio. Really? Or does he work for the rich, like this guy, Jeff Bezos, who's been dumping billions of dollars worth of Amazon stock? So even if there is a Great Depression out there, Jeff Bezos would say, well, what, there's like a Great Depression out there? Well, it feels great here. But I know, I gotta stay positive, folks. This is my New Year resolution. No more FUD. No more doom and gloom. We gotta stay positive. And here's positive for you. In the Fed minutes, the FOMC minutes, it reads this. In addition, participants remarked that the committee should continue to be prepared to adjust the pace of purchases if warranted by changes in the economic outlook, quote unquote. And the translation is, we'll crank QE back up as soon as anything goes wrong. So let's cross our fingers here and hope that Papa Jerome is bluffing and he's going to produce even more cocaine than Pablo Escobar. More positive news for you. What if inflation is indeed transitory? Listen to this. The ISM's gauge of factory activity fell in December to its lowest level since January 2021. Prices paid for materials also fell to their lowest level in more than a year. And as you can see, the gauge for prices paid, the gauge for supplier deliveries, all down, and all in all, the headline reading for the ISM Manufacturing Index ticked down, and it is the lowest reading since January 2020. Yeah, good news. The economy is slowing down, and therefore inflation is slowing down, and hence, bad economic news is good news for the stock market because it means that Papa Jerome will not cut the coke from the market. Matter of fact, he might even accelerate the pace of cocaine. Okay, out with the positivity, back to the FUD. Because after all, as the great Michael Caine would say, some men just want to watch the world burn. And what is life without the FUD? These gauges went down due to the Pokemon variant. What happens after the variant is over? Two things. Either inflation gonna perk up higher again, or remember what I said about the consumer? They ran out of stimmies, they ran out of savings, and they're sliding those credit cards up and down, up and down, up and down. What if the economy slows down, yet prices remain high? Because I don't care what the ISM Manufacturing Index says. All I have to do is look at commodities prices, and whether we're talking about oil, gas, lumber, coffee, copper, grains, all of these commodities are surging higher. On top of that, we have a labor shortage and a wage inflation. So regardless of how many variants they're going to release, inflation will continue to get back bigger, stronger, and more vicious than before. Okay, but this is all confusing to me, bro. I don't understand. Just give me the tickers and send me on my way. Tell me which stock's going to pop higher tomorrow so I can buy calls or puts and let me go home. Let me make it simple for you. Look at this chart. The most important chart in the stock market right now, the 10-year yield. It is moving higher. Now, you gotta be in one camp or the other. As an investor, are you in the camp that says the 10-year yield will pop higher because the Fed will tighten, and without the Fed's largesse in buying bonds, bond prices will go down and yields will move higher, specifically on the 10-year. And therefore, I believe that the 10-year will move higher and will cross above 2%. Or are you in the other camp that says when the Fed tightens, the economy will dip into a recession, the yield curve will flatten, and we will see a rush to buy bonds again, and therefore the 10-year yield will drop down. Matter of fact, it might even go negative. You gotta choose which camp are you in as an investor. Because if you are, like me, in the camp that says the 10-year yield will blast higher, then here's what you do. You look at this chart and say, you know what? Every time we have a dip in this chart, the 10-year yield, I'm going to use that advantage to accumulate and buy the dip in the value stocks. Now, if you are in the other camp that says the 10-year yield will collapse and bond prices, the TLT, will shoot up higher, here's what you do. Every time you see the 10-year yield popping higher, watch for resistance levels. For example, we have 1.7. This is resistance number 1. Then we have 1.77%. That's resistance number 2. You watch how the chart behaves, and if it pulls back from resistance, then you buy the dip in growth, the high multiple kind of names, because they're going to blast higher. But if you're not an investor, if you are just a trader, then you don't give a shit either way. What you do is the following. When the 10-year yield is blasting higher, you buy puts on the high growth, high multiple names, the RKK, those kind of names. And when the 10-year yield drops, it becomes overbought, reaching resistance levels, and it pulls back, you dump these puts and you buy calls on the high growth, high multiple names. And you keep repeating that process over and over and over again, and you're going to profit as a trader. So you have the strategy as an investor and a strategy as a trader. Back to the fun. Why do we believe that Jerome Powell and the Fed has no other choice but to become even more hawkish? We talked about inflation, but Jerome Powell gave us a test. He said, yes, inflation is out of whack and it merits not only tapering, but also raising interest rates. And now, today, the surprise, reducing the balance sheet. Very hawkish. But he also said that there is another test that merits raising interest rates, meaning higher inflation on its own is not enough to raise interest rates higher. But there is another test. And this test is maximum employment. If we see dramatic improvement in the job market, then we're going to raise interest rates aggressively because we have met inflation out of whack and a decent recovery in the job market. And therefore, we're going to tighten the policy. We've been saying, folks, in this channel, with that understanding, now you know what the phrase good news for the economy means bad news for the stock market. Now you know what that means. Good economic news means the Fed will tighten the policy, reduce the flow of coke to the stock market, and therefore it's bad news for the market, and vice versa. Bad economic news merit more cocaine to the market, and therefore higher stock market prices. But I don't understand, bro. Why isn't the stock market tracking the economy? All I hear at CNBC, they tell me that the economy is great and therefore the stock market is moving higher. The problem is that they have designed the economy and the stock market to be in that way. The economy tracks the stock market, not the other way around like it used to be before. And the stock market is hooked up on coke for almost a decade now, more than a decade, and therefore the valuation's out of whack, and if the Fed cuts the coke, we have to sober up. By sobering up, we mean these valuations have to come down. And the crazy mania of buying stocks with no revenues, no profits, and shooting these multiples to the moon, that era is over once the Fed starts tightening. And by the way, don't tell Jerome Powell this, but the moment he starts tightening the policy, all of these gains in the so-called maximum employment will go poof, gone. Because when stocks go down, companies are going to start to become more conservative to preserve capital, so they're going to fire employees, and all of these gains are going to be gone, and then the Fed will have to push more drugs into the market to so-called rescue the economy. The problem is, what if inflation sticks and it doesn't go down even after tightening? That is the wild card. That is the real risk, which will prevent the Federal Reserve from rescuing the stock market and the economy. If we head into a stagflation crisis, that is the worst case scenario. But back to the point, the good economic news means bad news for the stock market. Today we got the ADP report, and guess what? Smashing expectations, because we got a blowout number. You see, they said the variant, the Pokemon, is going to reduce the pace of hiring, and therefore the Fed will become more accommodative, or at least push the tightening a little further down the road. Because the number we got today is 807,000 jobs created in the month of December, regardless of the Pokemon. Small businesses added 204,000 jobs, mid-sized businesses added 214,000 jobs, and large employers added 389,000 jobs. The goods producing sector of the economy created 138,000 jobs, 2,000 in natural resources and mining, 74,000 jobs in manufacturing, and 62,000 jobs in construction. The services producing sector of the economy produced a stunning 669,000 jobs in December, 138,000 in trade and transportation utilities, 85,000 jobs in education and healthcare, 12,000 jobs in information, 246,000 jobs in leisure and hospitality, despite the Pokemon. 24,000 jobs in financial activities, 130,000 jobs in the professional and business sector of the economy, and lastly, 36,000 jobs in quote-unquote other services. Again, is this full employment or not? It is way more than full employment. So the only hope left for the bulls here is the Bureau of Labor Statistics. When they produce their number, they gotta cook it down. They gotta show us a bad number. The economy created only 100,000 jobs. Matter of fact, the economy lost jobs. even though the ADP, the private sector of the economy alone, created over 800,000 jobs. But rest assured, you don't have to deal with all of this. Okay, Jerome Powell is going to cut the coke. Where do we go next? Where do we go where the cocaine is abundant? The answer is Japan. And Warren Buffett, the big buffet, already spotted this ahead of time. The greatest investor of all time plans a return to yen bond market. He's issuing bonds in Japan. Why is he doing that, by the way? The reason is the Japanese yen has slumped to all-time lows. Why? Because the Japanese central bank is still in the so-called accommodative mode, meaning producing a lot of coke to support the Japanese stock market and the economy. Now, your question might be, well, how come the Japanese don't have inflation while the coke is going on? How come we got inflation and the Japanese don't? The answer is, when our central bank, the Fed, prints coke, the population snorts that right away. They splurge in spending, buying iPads, iPhones, traveling, and therefore that produces inflation. The Japanese, you give them coke, they store that, they save it, and therefore it doesn't produce inflation. Matter of fact, it produces deflation, and the Japanese are saving the coke for a rainy day. You see, Warren Buffett is outperforming the market here because he's Warren Buffett, and he always gets the last laugh. Warren Buffett is too old, bro. He's a dinosaur. He missed on GameStop. Really? Warren Buffett is outperforming the market because his Japanese holdings are outperforming the indices even in Tokyo. And let's conclude with this. It's a scary time. A lot of FUD. The Fed is becoming too hawkish. I continue to buy the dip on RKK, Tesla Witch Cathy Wood, and Tesla, and the other mania stocks, AMC, GameStop, and I continue to catch a falling knife. I say this, look, I want you to be healthy, but this whole dry January thing, that's not gonna work. Because we have a lot of FUD ahead, and you're gonna need to drink a lot. Even Pabst Blue Ribbon says your choice is either to drink beer or go ahead and eat ass if you don't like it. You wanna participate in dry January? Fine. Go ahead and eat ass. And I say, you know what? I know there is a meat crisis in this country. Prices are surging higher. Be it pork, be it beef, be it bison, be it chicken. But I'm not too desperate to eat donkey meat, and therefore I'm gonna stick to
Pabst Blue Ribbon!
Anyways, with that out of the way, let's move on to cover the market information, starting with the performance. And here we go! The Dow Industrial Average closed in the red, down 392.54 points, or a decline of 1.07%. The Nasdaq leading the declines, down by 522.54 points, or a decline of 3.34%. The S&P 500 also down by 92.96 points, or a decline of 1.94%. What about the sector's performance today? Awful, shame on every sector of the market today. They're all closed in the red, no medals today. And the laggards were led by technology, communication services, and REITs. What about the advance to decline ratios? NYSE 21% advancing versus 76% declining. The Nasdaq 19% advancing versus 78% declining. Now, you and I know every time we have these exaggerated numbers to the downside, the ratios, that produces a rebound higher. It doesn't mean that the market will trade higher tomorrow, but it means we should see a rebound at least in the pre-market, in the overnight market, the futures. Moving on to commodities. What's going on here? They looked pretty good earlier in the day, but then came Jerome Powell with the hawkish commentary. Despite that, crude oil prices closed in the green with modest gains for both the WTI and Brent. And look at this, crude oil Brent is trading above $80 a barrel. That might not last because the market has to digest the commentary from Jerome Powell and the FOMC minutes. But regardless, we have heating oil up and natural gas prices also popping higher, while gasoline pretty much in the flat line. Let's do some energy news here. The headline from Bloomberg reads, U.S. oil market braces for a $4.6 billion worth or wave of selling. What's up with the FUD now? Here it is. Every January, the world's two biggest commodities indexes, the S&P GSCI index and the Bloomberg Commodities Index reset, spurring a raft of inflows and outflows across commodities market. For WTI, that means investment tracking both benchmarks could be ready to pull almost 60 million barrels worth of futures contracts from the market, according to Societe Generale. What about gas? Natural gas prices, the crisis between the US and Russia, the volatility in the gas market is absolutely insane. We're talking about natural gas, of course. If you've been watching this program, you know that there is a massive arbitrage opportunity in the natural gas market because the price difference in Asian natural gas prices and European natural gas prices is wide enough to create this arbitrage opportunity. And therefore, we're seeing a lot of tankers diverting from China and other Asian destinations to the European market. And as you can see, we have tankers that were heading from Africa to China or other Asian destinations, making a U-turn and heading back to European nations to take advantage of the arbitrage opportunity. And look at this, all of these ships were originally heading to Asia, but to take opportunity of the arbitrage, they're diverting back to European destinations. What does that mean? Soon enough, we're going to see European gas prices moderating and pulling back, while Asian natural gas prices moving back higher again. And commodities traders are vicious. They will take advantage of all of these arbitrage opportunities. What does that mean? It means they're going to start to buy the dip in US and Asian natural gas. And notice this, we have ships that were originally heading from Texas to Asia, now diverting and taking advantage of the arbitrage in Europe. The problem is, Texas natural gas production is down. What does that mean? If we have yet another deep freeze crisis in Texas, I don't know what the temperatures are right now, but if we have another storm, plunging natural gas supply shows Texas is still not ready for cold. As you can see, the supply dropped dramatically in the month of December. What does that mean? If you live in Texas and you get hit with another storm like last year, prepare to freeze your nuts. Back to the futures, what about softs? We have gains for lumber again, gaining over 2.5% today alone, while we have flattish activities for coffee, cocoa, and cotton. On the other hand, we have losses led by sugar, down over 2% today, and then we have also modest losses for OJ. What about metals? Mixed picture here, mostly down because the 10-year yield blasted significantly higher today. And unlike yesterday, when gold, for example, rallied higher, hand in hand with the rise in the 10-year yield, today we're seeing the opposite picture. And this is going to go back and forth, until investors decide that gold is a safe haven. Absent of that, this negative inverse relationship will continue. And therefore, we're seeing gold down, silver down, even copper down, while palladium pretty much in the flat line. Yet we have gains for platinum here, gaining over 1% today. What about meats? We have a pop higher in lean hogs, gaining almost 3% today. On the other hand, modest losses for live and feeder cattle futures. Lastly, what about grains? The pop in canola continues, gaining over 2.5% today. Likewise, we have gains for soybean oil, almost 1.75% worth of gains today. On the other hand, flattish activities for soybeans, soybean meal, and rough rice futures. And the losers, led by wheat, corn, and oats futures. Now, certain grains prices will drop down, perhaps oat, even though California doesn't produce a lot of grains that you see right here. But regardless, the headline reads, California is suddenly snow-capped and very wet. Okay, but how long will the water rush last? We have yet to answer this question, but the bottom line is the following. The drought crisis in California has improved dramatically, as you can see from this map. We had severe drought in December 21st, and after the storm, look at what happened. Magic. We still have a drought problem in California, but it is not a drought crisis anymore. What a difference a week makes. But here's another commodity that I want to talk about, lithium. Lithium prices are shooting significantly higher. And the reason is we have a new election in Chile, one of the largest producers lithium. And the assumption here is this guy is not going to allow US and Chinese corporations to exploit the wealth of Chile, in this case lithium, and pollute the environment, reduce the water resources in the production of lithium without making that process costly, be it with taxes or regulations. And therefore, lithium prices are shooting up higher. This is a problem for all of these EV manufacturers because it's going to cost them more to produce these cars. And you have geniuses like Transportation Secretary Pete Buttigieg, whatever his name is. He says if you buy EVs, you don't have to worry about gas prices. Hey, Mayor Pete, I got to worry about the sticker price of these cars. The average price of a used vehicle, for example, is now sitting at $29,000. The assumption is, with the massive pop in lithium prices, it's not just lithium, by the way. It is nickel, it is tin, it is zinc, It is cobalt. All of these input prices for EV manufacturers are surging higher. That means when these EVs actually come out, you're going to pay an arm and a leg for them. Now, to stay competitive, these EV manufacturers will have to control the cost, meaning reducing their margins. So in the long run, is the rise in lithium prices bullish or bearish for EV manufacturers like Tesla, GM, Ford, and the rest? The answer is it is bearish, because they're going to have to stay competitive here. And if the government subsidies are not going to happen via the Build Back Better plan, then they're going to have to reduce the cost to the end consumer, meaning eating losses and reducing their margins. On top of that, we have an EV war between all of these manufacturers. They're going to compete to win your purchase. And who's to say that when these EVs are finally out, the economy is not going to be in shambles, and the purchasing power for consumers is not going to be dramatically reduced? And if that happens, they're going to have to sell these cars at a lower margin, or perhaps even losing money, because the input prices are surging higher, yet these manufacturers, electric vehicle manufacturers, do not have the pricing power that, say, consumer staples like Procter & Gamble enjoys. The bottom line here, folks, is the so-called EV party in the stock market will be over, because these companies cannot have the pricing power to combat inflation at the end of the day. In this market, you got to stick with companies with reasonable valuations, but most importantly, the pricing power. Anyhow, we're moving on to the big casino, the options market. What's going on here? The hottest table by far remains Apple at around 1.4 million contracts traded today. About 67% of those were calls. At number 2, Ford, with a little over 1.1 million contracts traded today. About 66% of those were calls. And at number 3, Tesla, the souffle, with about 900,000 contracts exchanged hands today. About 53% of those were calls. What about the unusual activities that took place in the options market today, starting with the ticker AMC? Beaten down, it lost the 26 support, but somebody's bidding for a rebound here in 2 days by buying the important number 26, the 26 calls. The expiration date, January 7th, with the expectations that AMC will rebound by over 13% by then. They paid about 28 cents apiece to enter this trade. All in all, spending about $400,000. What about the ticker ZEN for Zendesk? They're buying calls here, the 115 calls for the expiration date March 18th, with the expectations that the name could pop higher by more than 18.5% by then. They paid about $3.35 apiece to enter this trade. All in all, spending about $4 million. What about the trade for the ticker KRE? This is the regional bank ETF, which rises higher when the 10-year yield pops higher. Somebody's buying calls here, expecting more gains to come. The $80 calls for the expiration date, February 18th, with the expectations that the name could pop higher by more than 8% by then. They paid about 70 cents apiece to enter this trade, all in all spending about $700,000. Now, what about the trade for the ticker SNOW, Snowflake? My hunch here is, because we've seen massive trades for this name, that an executive, a large holder of Snowflake, is dumping calls, or writing calls I should say, to raise cash. They're holding the stock, they're not going to dump the stock, and therefore they're writing calls, covered calls, to raise cash. Regardless, somebody's buying those calls, the 330 calls for the expiration date March 18th, with the expectations that the name could pop higher by more than 11% by then. They paid about $18 apiece to enter this trade, all in all spending about $10 million. What about the trade for the ticker TDOC, Teladoc? Beaten down, one of the main components of RKK, but they're buying more puts here, expecting more pain to come. They bought the 75 puts for the expiration date, February 18th, with the expectations that the name could drop down by more than 11% by then. They paid about $3.40 apiece to enter this trade, all in all spending about $2 million. What about the trade for the ticker CVNA, Carvana? They're buying puts here, a lot of them. The 175 puts for the expiration date, March 18th, with the expectations that the name will drop down by more than 12% by then, and they paid about $15.50 apiece to enter this trade, all in all spending about $7.7 million. And what about the trade at the bottom of the table for the ticker TEAM, Team? This is a software name, Altacian, one of the top performers of last year. The problem is it is a high multiple name, and with interest rates popping higher, it's not going to perform so good. But somebody's buying calls here. The 340 calls for the expiration date, February 18th, with expectations that the name could pop higher by more than 8% by then. They paid about $16 a piece to enter this trade, all in all, spending about $8 million. And what about the heat map analysis? What's going on here? Pain across the board, tsunami, a red tsunami here, a lot of pain, but we have certain value names outperforming, the likes of Intel, AT&T, Verizon, and the consumer defensives, of course. The consumer staples, the likes of Procter & Gamble, Coca-Cola, Mondelez, Hershey's, General Mills. We also have the value names within Big Pharma like Merck and J&J, even Pfizer popping higher. We also have steel. Part of the inflationary names are still outperforming, yet they got a hit too after the FOMC meetings. They closed at the lows of the day, but yet we have steel, an inflationary sector of the market, outperforming, along with energy, Exxon, Chevron, all closing in the green. Some notable action here from GM. Today, CEO Mary Barra came out and she was pumping. Why not? You gotta squeeze every juice left in the mania. And she unveiled the Chevrolet Silverado pickup, the electric pickup. Yesterday, Ford talked about the F-150 Lightning. Today, Chevy is answering with its own electric pickup. Now, I don't know how practical these electric pickups are going to be, because if you're hauling a lot of weight, how is that going to impact the battery and the mileage, etc., etc.? A lot of pickup owners are going to stick with the GCE, the gas combustion engine, and the reason is it is practical, unless gas prices surge out of whack. GM also unveiled a concept car, the autonomous Cadillac. It looks good, but I don't know if they're going to produce it or not. For now, it is just a concept car. But Mary Barra is taking advantage of pumping. And this is hilarious, by the way. General Motors claims it will sell autonomous vehicles to consumers by middle of decade, quote unquote. GM is channeling its inner Elon Musk. Robo-taxis by 2019. People are going to be in Mars by 2030. The Cybertruck is going to be out by 2021. Whoops. GM also dropped another one. They said the Bright Drop division, which supplies electric vehicles to FedEx and Walmart, well, they say those two clients are upping their purchases of these particular trucks. Despite all of that pumping, GM lost all of the gains for the day and closed down by over 4.5%. We also have another EV manufacturer, Rivian, did not perform so good today, down over 11%. And the reason is, remember when the IPO happened, the pumpers said, you gotta buy Rivian. Who cares about the valuation? Because they have Amazon. Well, Amazon is dumping Rivian. They're making deals along with the Rivian deal, in this case with Stellantis. So Rivian is down big today. Not to mention the fact that it is an insanely overvalued name, and with interest rates popping higher, Rivian will go down to the dumpster. Another notable mover today is Beyond Meat. Beyond Meat surged higher in the morning by over 4% after KFC announced that they're going to launch the plant-based chicken in the restaurants. To each his own, not my style, but regardless of the pump in the morning, Beyond Meat lost all of the gains, and it's gone, just like that, and closed down with losses of almost 4%. And here is the heat map ETF. A bloodbath across the board. Everything is down, including energy, by the way. But notice that the XLE, which includes the large producers, Exxon, Chevron, BP, etc., outperformed the XOP, which includes the smaller high beta players in oil and gas. Likewise, notice the outperformance of value versus growth. They're both down, and this could be the theme of the year, by the way. Everything goes down, yet value outperforms growth. Not good enough. We're looking for profits here. But what if the entire market goes down? That is a possibility you have to keep in mind. And perhaps the action today is telling. We talked about the XLE outperforming, even though it's down. The XLB, materials. The XLU, utilities. The XLP, the consumer staples. They're all down pretty much in the flat line. But the theme is clear. Value, high dividend stocks, old school stocks, are outperforming in this market so long as the bond market continues to act the way it's acting right now by pushing the 10-year yield higher. Moving on to charts, starting with SPY, 30 minutes chart. What's going on here? After the gap and crap, the bearish consolidation resulted in a massive flush down, which was exacerbated by the Fed minutes. The chart now lost the support of 470. Is this bullish or bearish? The answer is, it is bearish. The bears are gaining advantage here. The problem is the chart is oversold for now. We could see a bounce, a reattempt to recapture 470 as support, but the bears took advantage here and they are in charge. And therefore, if the action continues, We're looking down for 466.5 as the next support. But bear in mind, there is another gap at around 467.69. That gap could be closed, and we will see the reaction of the chart at that point. And here's a daily chart for the continuous contract for the S&P 500. The formation was bullish, a bull flag. But there were worrisome signs, with the volume rising higher on down days, with the momentum indicators stalling, with the action in the 10-year yield. We talked about all of that, the fundamentals versus the technicals, and therefore, this was a bull trap. Are you seeing a massive flush down, erasing some of the gains of the so-called Santa rally? Now, you gotta keep in mind, the chart is trading above 4,657, the bull to bear advantage line, and therefore, in this chart, the bulls still have the advantage, because what if what we saw today is a knee-jerk reaction, throwing everything with the baby water out? What if after digestion, market participants say, you know what, who cares? Interest rates are rising higher, the 10-year yield is pushing higher. This is good for financials. It is good for regional banks. It is good for materials and inflationary stocks and value stocks. All of these sectors of the market are included within the SPY, and therefore, if they continue to outperform, this will keep the SPY outperforming the Qs, and it could keep the S&P 500 afloat, even trading higher, depending on the performance of the big caps. If the big caps stay flat, or perhaps suffer modest losses, yet energy, financials, industrials, materials, defensives continue to outperform, then don't be surprised to see the SPY trading positively. It's only going to trade negatively if the big caps start to melt down, because even if energy and the other inflationary sectors of the market, including value, continue to outperform, the big caps are just too big to fail here. They compose almost 25% of the index. When we look at the momentum indicators, they're curling down, about to cross into negative divergence. On top of that, look at the volume. Massive surge in volume on a down day. So yes, the bulls technically have the advantage, but the bears are closing in big time. And here's a 30-minute chart for the Qs. What's going on here? A flush down, closing at the lows of the day. Is this bullish or bearish? The answer is it is bearish, which means we will see more pain to come. We're looking at the support of 379. The only thing that the bulls can cling on is the fact that the RSI is getting oversold. So we could see a bounce higher in the overnight market, perhaps. The NASDAQ opens higher in the morning and we see another gap and crap. The bottom line is the bears are now in charge. And here's the daily chart for the continuous contract of the NASDAQ. Look at this. A massive failure of retesting the sloping line of support, now resistance, but who cares? Because the chart violated even 15,975. The selling was intense. Look at the volume, massive surge higher. Is this bullish or bearish? It is indeed bearish. Likewise, unlike the SPY, both momentum indicators, the RSI and the MACD, are trending negatively. In negative divergence. Once again, is this bullish or bearish? It is extremely bearish. We have to identify support now, and I will choose the round number of 15,000. It is actually a little higher than that, but we have to be conservative here. If the selling continues, we will see how the chart reacts to around 15,500. Look at this so-called Santa rally. It's poof, gone. Santa delivered the bags. And let's move on to a 30-minute chart of the IWM, the Russell 2000. Let's take a look and see here. And ooh, what a load of pain here. If you thought the NASDAQ ate it on the chin, look at this one. Massive flush down, straight down, losing the support of 223. Not only that, but losing the support of 218 too. If the action continues, we have to look down at 211 for support, but before that, we have a gap at around 213. But boy, this is a negative development in the IWM, the Russell 2000. And here's a chart of the Dixie, the dollar index. What's going on here? Still holding 96 as support. It was trading negatively earlier in the day, but when the FOMC minutes came out with the extra hawkishness, the dollar recovered, yet it did not close at the highs of the day. The dollar has a lot of tailwinds. It's not just the hawkishness of the Fed's policy, but it's also the weakness in foreign currencies, helping the dollar to stay afloat. And this is not good for gold. Gold traded higher today, pretty much erased all of the losses from about 2 days ago, yet it reversed after the FOMC minutes and closed at the lows of the day. Yesterday, gold did not care about the pop in the 10-year. Today it did. Can we read into this activity? Is 1.7 too much for gold? Who knows? But this is not going to change, folks, until the mentality and the psychology for market participants change. And that will only happen when market participants start viewing gold as a safe haven. And here's the chart of the 10-year yield. We talked about it earlier in the video, but we are at resistance, folks. 1.7. If it pops higher again, 1.77 is the next destination, the next resistance. Look at the momentum indicators. They're getting closer to overbought territory. What does that mean? Don't be surprised if we see the growth, momentum names, NVIDIA, for example, rebounding higher as we see a pullback in the 10-year yield. This is not going to go higher in a vertical line, a straight line higher. We're going to see stops, we're going to see pullbacks, and these pullbacks will push names like RKK and Peloton, NVIDIA higher. So as a trader, you have to keep an open mind here looking at this chart, because a name like RKK, for example, or Peloton, these names are in bear market territory, and you and I know the bear market rebounds are notorious. They can produce 10, even 20% gains in a short amount of time. As a trader, you don't want to miss that. So once you see the 10-year yield cooling off, facing resistance, pulling back, you're going to buy call options on these beaten down names, the high growth, high multiple names, because these rebounds will produce massive gains in the options market. And then you watch for support in the 10-year. When it rebounds higher again, you dump these calls and you switch back to puts. And this is a classic bear market strategy, by the way. Moving on to the TLT weekly chart, what's going on here? It is firmly below 149. The momentum indicators are giving us a confirmation of the weakness in the TLT. This is a weekly chart, by the way. The selling is happening on higher volume, and the week is still young. We have 2 days to go here. All in all the indicators say TLT down, yields higher. Sell the rips on the TLT and buy the dips in the 10-year yield. And here's a 4 hours chart for the VIX. As I said before, so long as the 4 hours chart, the MACD indicator specifically, is still trading in the green, showing green impressions of the histogram, the VIX will pop higher and the SPY will pull back. This is exactly what happened. The VIX popped higher, it retested 20 as resistance, and pulled back from that point on. It doesn't mean that the pop is over. The VIX is gathering energy, recocking the gun to have another pop higher. This is the reading for now until we see red impressions on the MACD indicator from a 4 hours perspective on the VIX. And since we opened the VXN can of worms yesterday, let's see what's going on here in the VXN, which is the VIX for the NASDAQ. It is certainly stronger than the regular VIX. When we look at the MACD indicator, for example, it is a lot stronger than the regular VIX from a 4 hours perspective. We're seeing green impressions in the histogram and notable strength in the RSI indicator, and so far the pop in the VXN produced about 25% gains. Looking at all of these indicators, we're not through yet with the pullback in the NASDAQ. How do you know that the pullback in the NASDAQ is over? Watch the chart of the 10-year yield. Once it starts to top and it pulls back, that is indicator number 1. Indicator number 2 is the VXN. Watch how this indicator acts from a 4 hours perspective. If the MACD indicator starts to curl down, producing red impressions on the histogram, and you see the RSI severely overbought, and perhaps the VXN is facing resistance at around 30. You combine that with the 10-year yield, and you'll know right away where the bottom is going to be in the Qs, and you can switch strategies as a trader. And here's a 30-minute chart for Apple. What's going on here? As you can see, we had a sloping, descending line of resistance, which acted as resistance for a while until the chart broke above that line, and then it started to act as support. Not once, not twice, but 5 times. We saw the pump and dump scheme pushing Apple all the way to the 3 trillion threshold, and then they dumped right away. And I predicted that. I talked about it in a tweet. I said they're buying weekly expiration calls to pump the stock higher to get the headline, the 3 trillion headline, and they're going to dump it right after that. And this is exactly what happened. And SEC Chairman Gary Gensler remains in a coma. If Apple continues to pull down, and by the way, breaking the sloping line of support, is this bullish or bearish? The answer is it is bearish, and therefore we have to look down at 172.4 for support. And here's a daily chart for Apple. As you can see, the momentum indicators are in negative divergence right now, and they're curling down. Is this bullish or bearish? The answer is it is bearish. Likewise, we're seeing 2 days of selling here on higher than average volume. Is this bullish or bearish? All of these signs are pointing out that the action in Apple is bearish. As Apple goes, so will the market. Again, we're looking down for support at 172.4. If that doesn't work, then we have a gap down at around 165.32. Now, what about 30 minutes chart for the souffle Tesla? What's going on here? The bear flag is playing out. Tesla got rejected again. From where? 1,174.5. And it pulled down, and now it is trading at the support exactly of 1,090.5. If that doesn't hold and we see more downside in the morning for Tesla, we have a gap. That gap could be closed. If that doesn't hold, then we have 995 to look forward to as support. Moving on to tulips, BTC, what's going on here? Not good. Cue the fire thing. Here it is. Give us another one and another one, because this is not looking good. You have negative divergences on both the RSI and the MACD. You have a bear flag formation that is playing out. On top of that, the selling is happening with higher than average volume. We have to see how 42,000 will hold. If it does and we have a confirmation, then we're good to go. If it doesn't, then watch out. We're going to see a complete collapse here in the tulip market. What about AMC? 30 minutes chart, what's going on here? Bounced a little higher from the oversold conditions, but there is no follow-up here. They're not buying the stock, they're not buying call options, and now the chart lost 26 as support firmly. If it closes the week below 26, that will serve as an ominous sign to run for the hills. I'm sorry, but the short squeeze will not happen. Whoever told you that was lying to you. Either you're going to stampede and buy the stock again in another episode of the mania, or it's not going to go higher. That leads us to the discussion for GME GameStop. This is a weekly chart. Any technical analyst that tells you they can read the movement of the stock from this chart, they're lying to you. There is nothing of technical significance in this chart at all. What's going on in this chart is a momentum play and a psychology play. That's all there is. So the technicals, that's a no-go. What about the fundamentals? You can argue that GameStop is a value stock if you look at the price to sales ratio at around 2. The problem is GameStop has been cheaper before. It has been a so-called value stock for a long time, but in fact it is a value trap. And the reason is, you look at the metrics, the ratios, the profitability ratios in specific, they're all negative, with the exception of the gross margin, which has been positive, by the way, for years. Yet the current gross margin is well below prior years. And the rest of the profitability ratios are extremely awful. There is no fundamental argument here to buy GameStop. I think you and I know that exactly. And just to cement that, look at the revenue, for example. It is trending down year after year. This is not a good sign. What about the profitability, the net income? Believe it or not, GameStop was profitable back in 2014, 2015, 2016, even 2017. Right now, it is losing over $150 million. So again, I think you and I know this is not a fundamental play at all. You cannot support your decision to hodl GameStop with diamond hands based on the fundamentals. You're not going to find any support there. The only argument is the short squeeze. The problem is the short float for GameStop is only at 13.6%. That is not enough. The short float at some point was over 100%. And I told you back then, folks, when the shorts cover, it doesn't produce massive pops. When they cover, all what you're going to see in the stock is flattish activities because the shorts cover in increments. Matter of fact, the SEC did an investigation on what happened in GME GameStop during the mania. And they concluded that yes, short covering had a role in the pop higher, but the majority of the pop was due to the stampede of extreme buying. It was a global phenomenon. Everybody bought it. They poured billions and billions and billions of dollars to buy the stock in a short amount of time. This was the reason for the pop higher, not the short squeeze. And today we got the news that the hedge funds that got involved in GameStop, yes, they lost a lot of money from the short squeeze. But guess what? They are recovering their assets under management. Melvin Capital started 2022 with $11.7 billion of assets under management. That is down from January 2021 before the short squeeze in GameStop when their assets under management were around $12.5 billion. At the end of the short squeeze, those assets went down to $8 billion. A lot of pain here. They lost a lot of money, but they are recovering. And soon enough, they're going to recover all of the losses in the so-called short squeeze. The question is, are you going to recover? Because whoever told you that what's going on in GameStop is a short squeeze and you got to wait till the shorties cover and GameStop is going to go to 500 to 1,000 to 100,000, they're lying to you. They're a bunch of fools who didn't even finish college. They seized on the mania to gain popularity. That's all there is. This channel did the opposite. We told you back then, this is stupidity, this is mania that's not going to end well at all. And we get attacked for it. We did not gain thousands of subscribers or popularity. We got the opposite. But my principle at the end of the day is, I gotta be right in the long run. I cannot deceive the viewers of this channel for short-term gains. So at the end of the day here, As a holder of GameStop, you have to ask yourself the following. Did I join this mania of buying GameStop because I firmly believe in the future of this company, or did I get in to seize an opportunity to make quick profits? And that fired back on my face, and now I'm using the short squeeze as an excuse to continue to stay hopeful. If you are in the latter camp, you have to reflect here because you will suffer severe losses. This is not going to end up well for you. If you are in the first camp, the true believers of GameStop as a company, then you have to get together and act as active investors and force and push this company and its management to start to reform and produce new products and change strategies to excite new investment dollars into the stock, because this is the only thing that's going to push this stock higher. More money flowing into GameStop, not the short squeeze. And lastly, as a holder of this stock, for the love of God, when you see bond yields on the 10-year popping higher, buy some puts to protect yourself from a downside. When the 10-year yield tops and starts to cool down, then close these puts and buy some calls to maximize your profits. I'm never going to convince you to dump the stock. I'm not going to advise you to buy or sell or hold. That decision is up to you. It's your money. Do whatever you see fit with it. But for the love of God, use option strategies to make some money here. Don't just sit there idle hoping for the holy short squeeze. Buy puts and calls accordingly to maximize your profits. And if you have 100 shares or more, you can sell calls. For example, you see the 10-year yield popping higher, you might want to sell covered calls to raise some cash as GameStop stock pulls back along with the other high valuation names. Look into these option strategies and ask me questions if you have some. But for now, I'm moving on to the conclusion of this video. What do we have on the economic calendar tomorrow? We have the weekly jobless claims. This will be important as a confirmation of the ADP report that we got today. We also have trade deficit, the ISM services index, factory orders, and we also have another Fed zombie speaking here. And this could terrify the market, by the way. If you thought Neil Kashkari becoming a hawk was bad, well, James Bullard has been a hawk for a while now. And I know for a fact that Mr. Bullard is not happy with the insane money printing policy of the Federal Reserve. And we also know that Mr. Bullard likes to smoke a little hash, and he gets a little high and issues insane statements that rattle the market. So could we get another statement from Mr. Bullard that shakes down the market even more? We'll see. But for now, folks, this is all I got for you. Thank you for listening. Thank you for watching. I will talk to you again tomorrow.